Hello there and welcome to this video. It's been a while since I recorded a financial deception video, but I recently stumbled upon a company that I think the PE ratio falls within this category. I think that the PE ratio is overrated in general, and this particular example is not really an extreme one. I've seen it happening many times when it comes to public companies, private companies as well. But I think it's one that it takes a bit of accounting knowledge to better understand, and hopefully through a simple example, you will be able to follow this from now on. Now, the PE ratio for this particular company, Nokia, is misleading. If you take a look at the PE ratio, it's slightly below 5. The share price is down about 18% over the last year, right? So let's keep those two numbers in mind. So a very low PE ratio that, based on the traditional valuation metrics, means that the company is trading at a very low level. And if you are to buy it in less than 5 years, you'll have your money back through the earnings, right? That is basically what we're starting with as assumptions. And of course, that is something that is not true. And most of the case, it's not true. This is not a casual valuation, so we're not going to go through everything when it comes to Nokia. I just want to focus on the PE ratio and especially focus on its development over time. So what I have here is the chart that shows how the PE ratio has been changing over the last 3 years. I'm looking only at the recent past, and you'll notice that during 2021, we could not calculate the PE ratio because in 2020, in the year before, the company was not profitable. So if a company is not profitable, there's no earnings, and therefore, because the PE ratio is lagging, we're using the historical data. In the year after that, there was no option to calculate a PE ratio. Then the year that followed, it was about between 15 and 20, decreasing to 13, and then, as you can see, in January 2023, which means the 2022 numbers were out, it went down from 13 to 5. Now, we know that based on the price that we just saw over the last year, the price went down 18%. So if we know that the price didn't change much, it means that the earnings changed a lot. And since the PE ratio decreased significantly, basically, let's say more than double, it means that the earnings went up twice. So we have a company that has twice the earnings in 2022 that it had in 2021, for example. And at the same time, the price is much lower. Does this make sense? I mean, at first glance, that it doesn't seem very logical. If anything, it should be trading at a higher multiple, right, based on the P ratio. Well, let's take a look at the earnings to better understand what drives this decrease of the PE ratio. And sure enough, we can take a look at 2020. There was a negative, first of all, a negative profit or a loss. Then it improved over time, and we can see also how that changed per share. So at today's price, of course, it's below 5 PE. Now, you can pause the video and try to figure out what causes this difference. I think it's a good exercise for everybody who wants to practice a bit their financial analysis skills, because if you take a look at the net sales, not much has changed. So from 21 billion to 25 billion, sure, there's some growth, but this is a significant change when it comes to the profit, from minus 2.5 billion to plus 4.3. Now, for those of you who would just like to follow the video, there is one line that makes basically the whole difference. And that is income tax benefit / expense. And you'll notice that in 2020, there was a profit before tax of 743 million, but income expense was 3.3 billion. That doesn't seem very logical, right? Then 2021 seems like a fairly logical year, 1.9 billion in profit before tax, paying 270 million or having an expense, income tax expense. That's not that unusual. But then take a look at 2022. They have 2.2 billion profit before tax. And then the income tax is benefit. So doesn't sound very logical, right? Well, there's a good reason for that. And this is, of course, the main reason why I think this example is worth sharing and really going into the details. There is something called tax loss carry forward, and I'll try to explain this through a simple example. Imagine that you're starting a business, and in the first year, you make a loss of 10,000. Now, in majority of the countries, the tax legislations allow you to carry that loss forward into the next year. So assuming in year 2, you make a profit of 5,000, you don't pay any taxes. Why? Because you had the 10,000 of loss that you carried from the previous year. You use that, and now you have 5,000 still remaining as a loss to carry even further into the next year, right? Year 3 comes by, you make 8,000. Now, out of the 8,000, you had 5 that you still carried forward from year 2. So for the remaining 3,000 in excess, well, that's the part that you're going to pay tax for, right? So that's the 750. So 3,000 multiplied by the tax rate of 25%. So this is very simple example, right? So should not have, it doesn't take a lot of time to understand it, right? Now, how does this reflect in the accounting books? If you have a loss of 10,000 that you can use in the future, basically it is an asset to you because it will save you from paying taxes sometimes in the future. What that means is the tax impact, which is the 10,000 multiplied by the 25% tax rate, that is what will be shown as deferred tax asset, among other stuff that could be in there. But one of the things that you'll see very often is the carry forward, loss carry forward on unused losses from the previous year. So there could be different terminologies used, but ultimately the logic is very simple. Company generated losses in the past, and the net impact, the tax impact, is what will be shown on the balance sheet. Now, if you are operating in multiple countries, you cannot use the losses from one country to offset the profits in another country. So this has to be towards the same tax jurisdiction. But there's one catch, and that is if you do not expect to use these losses in the future, you cannot recognize them. In some countries, you can carry them forward for 3 years. In some countries, you can carry them forward for 5 years. In some countries, there is no limit, but if within that time frame you are not expected to be profitable, then it doesn't make sense to recognize an asset because it's obvious you're not going to be profitable and you're not going to use that. So if this was the case, and let's assume that you could carry forward the losses for 3 years, now it's year 1, you made a loss of 10,000, year 2, you make further loss of 10,000, year 3, a further loss of 10,000, and so on. You cannot recognize an asset because you're not going to use that. It doesn't have any value. And this is exactly what happened when it comes to Nokia. And this is an extract from the report. In 2020, Nokia derecognized deferred tax assets in Finland as required due to a regular assessment of our ability to utilize deferred tax assets in Finland for the foreseeable future. Basically, the profitability in Finland was a lot worse than they expected. They did not see any positive improvement in the coming period, and they did not think that these deferred taxes that they had in the past, so the losses that they have generated in the past, will be used in the future. Therefore, they could not have them anymore on the balance sheet. So if you take a look at the deferred tax assets between 2019 and 2020, there's a huge decrease. So a lot of the losses that they've used, they said, well, we cannot use them. We're not going to make profits, so cannot have them on the balance sheet anymore. But at December 31st, 2022, Nokia concluded, based on its latest assessment, that it is probable that it will be able to utilize the unused tax losses and deductible temporary differences in Finland and re-recognized deferred tax assets of 2.5 billion. 2.5 billion. Right? So you see in 2022, there's this reversal or re-recognition. So in 2 years, basically there's an event related to unused or losses carried forward. Initially, they thought that they're not going to be profitable on time to use these losses, and then they changed this assessment based on the recent performance. So if we go back to the income statement, both years 2020 and 2022 are basically very unusual. In both of those years, there is an event that happened that had an impact, a significant impact on the financials in that particular year. But the PE ratio in none of those years is a fair representation of, what the PE ratio normally stands for, at least in the old school theory. So I think this is a great example of one simple event that has an impact on multiple years that distorts the PE ratio significantly. And if anybody is expecting that Nokia will be earning 4.2 billion a year in the future, well, that's not really the case, because what actually is the kind of the realistic earnings, right, even for 2022, We have 2.1 billion in profit before tax. Then the income tax benefit or expense, in this case, it's 2 billion, but within that there's 2.5 billion of the deferred tax losses that have been recognized. So it's actually negative 500 million. Therefore, we're looking at about 1.7 billion of profit for the year. Therefore, the PE ratio that we see below 5, probably it's more accurate at around 10 or 11. So I hope that you enjoyed this video. I know that it was a bit more diving into the accounting terms, but I hope that it's valuable, find it useful, and as always, I'll see you in the next one.